Welcome to Weekly Market Wrap. I'm joined by Bill Hubard as usual. Bill, I know it's not a favourite subject of yours, but we're going to have to talk tapering.
Yes.
What was the message last night?
Well, I think, first of all, when I first read it, I felt like Clueless in Seattle or Confused.com. Then I sat down and had a long chat with my good friend Jack Daniels, read it again, and then I realized, I said, well, they gave us no forward guidance. They didn't clarify anything, but, quote, they didn't dispel the feeling that we'll start Sept-tapering or Oct-tapering immediately. They didn't give us a definitive month or definitive time, but the market still, I think, what, 65% of the 48 people that Bloomberg had interviewed last week felt that we'd get at least, when the tapering started, at least 10 billion a month.
And do you think that's what the market, what did the market read into it? Because obviously we had a very volatile reaction.
Yes.
Not on the number, on the minutes release of the minutes themselves. Possibly, as you're saying, it took a little while to digest what was being said. But you know, and then so the markets. I think you could probably say safely that the markets finished on their lows. Not sure whether.
Yes.
Well, pretty sure it's coming. We look at Europe this morning, and it doesn't seem to be reading it the same way.
Well, I think the interesting thing was of course, when it was announced, you know, at 7 o'clock London time, Europe was closed, okay? And we'd had 4 consecutive days of losses on Wall Street. The first time we'd had that this year. They continued yesterday, again, on minuscule volume. But the first thing that we saw was, when the minutes came out, they did make feel initially, which the follow-through was, it was more hawkish than some of the people expected.
Yeah.
So therefore, you did see an improvement in the dollar, although, especially with the dollar, euro, and dollar sterling, it'd say it sold off 50, and then they picked up 25 at the close. But that's sort of, and then you saw the Treasury 10-year move towards the 290. I think it's 292 now. So the foreign exchange market says, yes, this is more hawkish, pro-dollar than we expected, more hawkish. So therefore, no more buying of bonds. So we saw the backup in the 10-year. But then, as you said, the stock markets continued to sell off in New York. I think mainly because it was just a continuation. And then we saw an improvement overnight in Asia. Now, was that down to Chinese PMI or down to the Federal Reserve? And I think basically they said, well, if the Federal Reserve says that the economy is gradually improving, that's got to be good for stocks. So we saw an improvement today in European stocks, but also remember we got a much better than expected Eurozone and especially German PMI, okay? And the Eurozone PMI, I think, was at a 26-month high. So it at least made me feel that the European Central Bank will not drop rates anymore. But even last night with the Federal Reserve minutes, it still showed that we will start tapering. When? I don't know. I would expect to finish probably by this time next year. But it also did not change the market's perception that the first Fed rate hike will be in the third quarter of 2015.
Okay, I think you're right, but I don't think there doesn't seem to be much confusion about that part of it. What I find a bit interesting is the dollar itself. Although you're right, it did strengthen a bit last night, it still seems to be a bit on the back foot. And the strength in the euro, the strength. I mean, I know against the exotics, for example.
Yeah.
Yes, well, all currencies have
Yes.
strengthened. And you talked about that many times in the past, but the dollar itself doesn't seem to be quite why I can't understand quite why. With rates definitely on their way back up, really, and as you said, okay, maybe Europe isn't going to cut anymore, but I don't quite see why there's not why. Well, I think it's confusing our clients as well. Why the euro is as strong.
I think one of the things, you know, both the Fed Reserve, Mark Carney, and the European Central Bank said we want to be clear. We want to give you forward guidance. Well, last night's minutes were not clear to me and didn't give forward guidance. And then, of course, you had Martin Wheel from the MPC, who, 2011, voted 7 times for interest rate hikes. He said last night / this morning in the paper, oh, I think we may need more quantitative easing. So, you know, you saw continued sell-off in sterling. Now, remember, there's been a major dichotomy with the euro and the dollar, or let's say the euro, quote, and the dollar, not euro-dollar. Because what you've been seeing is, you've been seeing the sell-off in emerging market currencies. Well, so much of that in Europe has been selling Turkish lira, Hungarian forint, Polish zloty, etc., and buying the euro. Now, the other big trade, of course, is the slight problem with it, both the Indian and Indonesian rupee and the Turkish lira. So they have been supporting the dollar. But I mean, we talked about this last week. You know, when we first got the quarterly inflation report, we saw sterling sell off down to 152. And then all of a sudden, you know, I thought that was the correct level. And then boom, in 3 weeks we went back to 157 almost. Yeah. Now, I think sterling now is coming off to a level where I think you're starting to see some shorts being set up there. 156.40 was a level that, you know, although we don't advise clients, it looked like a positive short to me, okay? Because, you know, that may be blown out of the water tomorrow when we get the GDP numbers. Yeah. But remember, even GDP numbers, we're coming from such a low level. Yes, I know we got positive PMI, but remember, we're coming from such a low level that we've got to have some kind of improvement.
Okay, do you think, I know they've got the Jackson Hole meeting this weekend, do you think we'll get any further guidance from there?
Well, I think probably the guidance we'll get will be what the snow conditions could be like. Because I think one of the things that I think it's been, quote, blown out of proportion, because really, you know, and this is quote, the Kansas City Federal Reserve annual conference, okay? So it's not the Fed, it's not the quote, the whole Fed, okay? It's just like Dallas has one, it's just Jackson Hole has become like Davos. Yeah. Now, one of the things, remember, and we knew this back in June, when Mr. Bernanke basically said, this is just a regional Fed meeting, okay? And knowing that he probably is going to retire on the 31st of January next year, he's not going. Mario Draghi's not going. Okay, I know the big push here is the president of the Bank of Brazil says, I better not go away because my country may go down the pan this weekend. So I mean, at least you got, I think the Bank of Japan head, Kuroda, is going to be the key to speak of. But, you know, who else is going to be there? Bono? Madonna? I mean, I don't know.
Started to lose some of its...
yes, I think so. And so, therefore, even now, you've got Janet Yellen not coming. Now, of course, you know, 6 months ago, she was, you know, odds-on favorite. Now I think she's 1 in 3. Larry Summers now seems to be becoming the, you know, the lead man. So no, I don't think we're going to get anything more. And of course, I'm not trying to complain about it. We've got, remember, August bank holiday this weekend. Yeah. The following weekend, we got August bank holiday in the States. So remember, we have another like 10 days. Yeah. But I think what we did, the minutes did say, is it's data dependent, which we all know all the key words, but how dependent? You know, we got jobless claims today. They weren't that great. It shows we are looking at the importance of, you know, the August non-farm payrolls, which is that the 5th of September. Yeah. So, but remember, so we have that, and then of course the day before we have both the Bank of England and the European Central Bank. Now, will anybody really back from holiday? So we've got a lot of data there. And one of the things everybody said, well, look at yesterday's housing data from the States. Oh, a 5-year high. But remember, was that a 5-year high because everybody wanted to get in early? Because if you look at mortgage applications, they're down 12% in the past 2 weeks. Because mortgage rates in the States in the past 6 weeks have gone from 3 3/8 to 4 3/4. So all of a sudden people, you know, say, well, you know, what does that mean? Well, that means that's all spendable income we have if we buy this house. So that could temper the housing market.
Application in before they move the rates
up. Exactly right.
Yeah. Okay. So do you think? I mean, the volumes are still a little bit on the light side. Do you think that? So you think that will continue through to at least the second week of September?
I think it has to, because
there's too many holidays.
Yes. Too many holidays, and as they told us, you know, as we already knew, data dependent. Well, why do anything when we know we got non-farm payrolls? We know that, again, forward guidance, we know we've been given a number, both from the Fed and now from the Bank of England, in reference to where is the unemployment rate, as we discussed last week. You know, the drop in last month's U.S. unemployment rate of going from 7.6 to 7.4 was basically my generation, the baby boomers saying, hey, I've had enough of this nonsense. I'm taking myself off the rolls. And remember, we're only about 2-ish years behind demographically here in the UK. So therefore, we may see near term an artificial drop in the unemployment rate of people going out of
job circulation.
Yeah.
Okay, so a week or two to digest the information that's coming up. put you on the spot. Do you see the Dow? Do you see the stock market higher or lower before we start to get those real numbers rolling in? How do you think the market is poised for this move?
I mean,
Poised for this kind of
I don't
quieter
know.
time.
I don't know whether this is a rule or just a rule of thumb, but basically it used to be 10 basis points move in the 10-year equated to 100 ticks in the Dow. Well, we've already seen that downturn. Now it's a question of the people that are going out of bonds. I don't think they're going out of bonds per se. I think they're going out of the long area of the market, 10, 15, 30 years. But you're seeing a huge move into the short-term paper, you know, anywhere from 18 months to 3 years. And some of that paper in the States, it may be lesser stuff. It may be municipal bonds. It may be ETFs. Some of that stuff is still yielding over 4%. Well, so if you want to park it, or has money been parked in gold, okay? Because we've seen a nice move in gold, and that's not supposed to move the way the dollars move. But it's going to be a question. I don't know how many people who do massive shifts from bonds to stocks to commodities and vice versa. So I just think what you'll start seeing will be people now, maybe they start readjusting their stock portfolios into stuff that are, less interest rate sensitive, okay? I mean, you got to look at the medical industry, you've got to look at care, you've got to look at age-related stocks and stuff, you know, and maybe you're going out of the Googles or the Apples or the high flyers. But it's going to be a question that I don't think anybody can realistically say, and I don't think anybody will realistically start making major market moves between now until at least 1:30 on the Friday the 5th of September. And as I say, I wouldn't expect either the Bank of England or the European Central Bank the day before that to make any kind of major decisions.
So maybe a bit of repositioning of stocks, stocks specific rather than index.
Yeah.
Okay, all right. Well, thanks very much.
Pleasure.
Thank you.